All right, let's dive right into this explainer. We're unpacking the latest Q1 performance and the future roadmap for India's largest private sector bank, HDFC Bank, for the quarter ending June 2026. It's a completely fascinating period for them right now. They're navigating the aftershocks of a massive merger, battling industry-wide liquidity pressures, and making a huge strategic pivot from a build phase straight into what they're calling a harvest phase.
We've got a ton of great data to cover today. We'll start with the banking behemoth, move into the Q1 financial snapshot, talk about navigating the headwinds, look closely at asset quality and risk, and wrap up with the harvest strategy.
So Section 1, the banking behemoth.
HDFC Bank isn't just large. It's a domestic, systemically important bank, often referred to as a DSIB. Following that historic merger with HDFC Limited, its market cap sits at a staggering $145 billion as of April 2024. To put that scale into perspective, that makes it the third largest company on the Indian stock exchanges, period. And globally, it's the 10th largest bank in the world by market cap.
And their absolute dominance in the Indian economy is just staggering. They hold a massive 14% market share in total banking system advances and over 12% in deposits. If we narrow that down to just the private sector, they command nearly 36% of all advances. They are quite literally a market leader in almost every single asset category they touch.
But all that scale is backed up by rock-solid stability. ICRA just recently reaffirmed their AAA credit rating with a stable outlook across their various bonds and facilities. This top-tier rating really reflects their highly granular liability franchise, their robust capitalization, and, honestly, their proven track record of maintaining comfortable asset quality no matter what the economic cycle throws at them.
Moving right along to Section 2, Q1 Financial Snapshot.
Looking under the hood at the numbers, there's a really robust 18.4% jump in net profit, hitting over 20,000 crores for the quarter. Now, when you're operating at a $145 billion scale, seeing double-digit profit growth is incredibly impressive. Sales ticked up just under 4%, and the return on equity held steady at 13.6%. That tells us they are highly efficient with shareholder capital, even in a pretty challenging environment.
To manage their balance sheet post-merger, management made a deliberate choice: prioritize deposit growth over credit growth. You can see deposits grew at 14% year over year, which outpaced the 12% growth in advances. The CEO actually noted that this deposit growth was relatively better than their historical Q1 trends, which basically allowed them to just keep grabbing more market share.
Which brings us to Section 3, navigating the headwinds.
Let's pause for a second and think about this crucial question. What happens when deposit costs rise across the entire banking sector? Well, industry-wide challenges in mobilizing deposits are putting immense pressure on net interest margins, or NIMs. For HDFC Bank, we saw margins compress from 3.3% in fiscal 2025 down to 3.1% in 2026. Basically, this happens when the yield the bank makes on its loans drops faster than the cost to reprice its deposits.
So the real issue here is this completely bifurcated market. On one hand, non-retail or wholesale deposit costs are staying highly elevated, mostly due to systemic liquidity volatility. On the other hand, granular retail deposit pricing is steady, sure, but it is intensely competitive out there. The bank did acknowledge a tactical shift toward more non-retail, shorter-term deposits recently. That's what pulled down their overall margins, though they view this as a strictly managed temporary headwind.
To really grasp their liquidity tension, we need to understand the credit-to-deposit, or CD ratio, which is a massive metric closely watched by the market. Simply put, if a bank takes in $100 in deposits and lends out $90, its CD ratio is 90%. A higher ratio simply means you have less of a liquidity cushion.
For HDFC, this ratio is currently sitting elevated at 95%. But context is everything here. This is actually a huge improvement from their post-merger peak of 110% back in December 2023. By purposely growing deposits faster than loans, they've aggressively wrestled this ratio back down to much healthier levels, aligning a lot more closely with long-term banking sector averages.
All right, on to Section 4, asset quality and risk. Despite all these economic pressures, their asset quality metrics are incredibly impressive and prove the bank maintains a massive cushion against any potential shocks. Gross non-performing advances are a tiny 1.15%, and net NPAs are just 0.38%. And beyond standard coverage, They are sitting on a fortress-like 37,100 crores in floating and contingency provisions. That's roughly 1% of their standard advances just tucked away for a rainy day.
And then there's corporate governance. After some recent sudden board exits, the board appointed a new part-time chairman, Rajiv Kumar. The CEO explicitly framed disappointment to analysts as a clear signal to minimize uncertainties. They really want to reassure shareholders that institutional stability remains a top priority at the board level.
Management also confirmed that their current provisioning is so strong that upcoming regulatory changes just won't cause a major financial hit. India's banking sector is moving to the expected credit loss framework in April 2027, but the CFO noted that because their standard asset provisioning is already so robust, they anticipate nothing material in terms of an overall credit cost impact from this transition. They're already prepared.
Finally, let's dive into Section 5, the harvest strategy. A massive part of this new strategy is shifting their asset mix. Currently, their retail mix sits at 52%, but they are actively targeting a return to roughly 60%. Why 60? Because India's consumption share of GDP is about 60%. Aligning their loan book with this macro reality allows them to capture those higher-yielding retail loans. It's a structural lever to recover those compressed margins we talked about earlier.
So they are officially moving from a build phase to a harvest phase. Think about it. Over the last 5 to 6 years, they've poured billions into technology and distribution. Now it's time to squeeze the efficiency out of those investments. This means capitalizing on specialized deposit windows like the FCNR swap, leveraging foreign currency non-resident accounts, and aggressively reducing turnaround time, or TAT, across all their branches to serve customers a lot faster.
To actually achieve this turnaround time reduction, they're aggressively pushing digital re-engineering. The bank is on the cusp of launching Gen AI lighthouse programs directly into production this year. They're augmenting cybersecurity defenses with AI and entirely reimagining digital analytics to automate back-end processes. This is huge because it releases human capacity directly to the front lines to actually serve clients.
And you know what? We're already seeing the harvest strategy work. Roughly 40% of HDFC branches are less than 5 years old, yet these newer branches are scaling to an incredible average productivity of 330 crores per branch. That's up from less than 200 crores just a few years ago. The CFO proudly described this per-branch productivity as one of the best in class in the entire industry, and it's easy to see why.
Recently, the bank actually had to intentionally slow down account acquisitions. They needed to implement strict algorithms and guardrails against fraud and mule accounts. But with those guardrails firmly in place now, the CEO says they are ready to press the pedal on granular customer acquisition. The goal is to return to pre-merger CASA levels, meaning a lot more low-cost current and savings accounts. Plus, considering only 14% of their existing customers have time deposits, there is a massive runway here to deepen wallet share through intense cross-selling.
Thank you for joining this explainer. Look, HDFC Bank has weathered the post-merger turbulence with strong profits, an improving CDR ratio, and an absolute ironclad balance sheet. So, I'll leave you with this final question as you watch how this banking behemoth navigates the remainder of 2026. Will their technology and retail push, this new harvest strategy, release enough margin and efficiency to completely outpace the fierce competition? We'll definitely be watching closely. See you next time.